every second person in Pakistan has a smartphone. It tells you everything about you. Proxies on your financial data, your behavioral data, your social demographic data, your geographic data. So we actually started developing algorithms studying this data. On the basis of that, we started lending.
According to some numbers from fintechs, only 21% of adults in Pakistan had access to a bank account in 2021. I don't want to stoke any regional rivalries here, but that's compared to 53% in Bangladesh and nearly 80% in India. So clearly, there is a need for some change. My guest today, Naureen Hyat, is one such change bringer. Naureen is the co-founder of Taze, now ZoodPay Pakistan, the country's first digital lending platform. They are providing the unbanked and underbanked with access to easy, affordable, and reliable financial solutions that fit their lifestyles, especially as those lifestyles embrace more and more e-commerce. Welcome to How to Lend Money to Strangers with Brendan LaGrange. Naureen Hyat, you're the co-founder and CEO of Taze Financial Services, now also ZoodPay Pakistan. Welcome to the show. You know, if we talk about the subcontinent, India gets a lot of the headlines, but I haven't yet looked at lending space in Pakistan. So I'm really quite interested in learning about what it was looking like and primarily what the changes are happening, what the future looks like for consumer credit in the country.
Thank you so much for having me, Brendan. It's a pleasure to be speaking with you on a topic that's really close to my heart. So, the journey to starting Taze, to be honest, I never thought, I'd be getting into entrepreneurship. That was never the plan. The plan was always to bringing impact and working towards a purpose. So, just to give you some background, the microfinance sector was created in Pakistan back in early 2000. And the mandate of the sector was to alleviate poverty. A lot of criticism was actually sought on the sector for having very high interest rates. But when you actually dwell deeper into studying the sector, you understand that the sector is very fee heavy. Now in Pakistan, at that time, the numbers were even more bleak. But in terms of bank account ownership, about 21% people have a bank account. In terms of credit, it's under 5% of the population that actually has access to formal credit. At that time, it was even much lower. If you talk about, being on the credit bureau, only 1 out of 10 people in Pakistan are registered on a bureau. Well, now the numbers are increasing. But, the microfinance sector was actually created with the mandate to alleviate poverty and enhance financial services, primarily credit to, the base of the pyramid. Banks don't lend to the masses. Why? Because, number one, there's no data on these consumers. Base of the pyramid consumers do not have suitable collaterals. And many a times, the banks, at least till then, did not have suitable risk rating tools to understand credit or, credit risk. So for microfinance, the models were structured such that it was all field intensive, where the field officers actually came from the field, from those communities to lead generate consumers, to understand how those consumers behave, more so to be in contact with the consumers so that, it was easier to manage defaults or credit risk. It was not only costly, but it was also time intensive. So on average, it took anywhere between 2 weeks to a month to give out a microfinance loan. So what happened was that we saw that most of these costs had to be passed on to the consumers. The interest rates, they were higher. Contrary to the belief of a lot of people that the margins of MFIs, the microfinance institutions were higher. Well, they were good margins, but not as high as they supposed them to be. So the credit risk was actually managed very well. So the defaults were, lower than 5%. But we thought that this was actually not going to be sustainable if this is how the costs would keep on rising. And it was for the consumer, the average APR was around 45-50%, which was something that was going to become worrisome in the future. So that's when my co-founder, Hamza, who was also working with me at the credit rating agency, and myself, we founded our first startup, which was also fintech, to digitize the entire credit disbursement process for these microfinance institutions. And the name of that was Check-in Solutions. And, the focus was to make the process much faster, reduce errors and reduce the costs ultimately.
Yeah, it's an interesting point to pick up on, because obviously the traditional narrative is that microfinance where we don't have a good credit data infrastructure is expensive to the consumer because the risk is high. But actually, before the digitization, it's the process is so expensive. So yeah, even 5% loss rates are not exceptionally high, but then you see 40, 50% interest rates. And some of that, as you say, is margin, but a lot of it is just a really hard to scale process when you have to send an agent out into a village to speak to some people, to give a few small value loans, and then to head across to another village. And early on, I did a project actually in Ghana with a bank that was doing their very first rollout of digital lending. And we mapped out their processes, and it was less agent-based. So it was even a better starting point, but it was still the branch manager could sign off this much, and then it went to a committee. And then if it was large, it went to another committee, and then it came down. And because it's all paper-based, everybody had to have a supervisor to check they were doing. The supervisor needed a supervisor. And you had this massive process. And we could say, well, before we build a credit score, let's not worry about anything predictive. Let's just implement it in the system. And immediately we can track it. We can get rid of all the human errors. We don't need so many committees. And then let's worry about credit prediction in the future. And that saved so much time. And we can't forget that a lot of the digital processes are saving the money, are reducing risk, not necessarily credit risk, but they're setting the scene for that as well.
Yes, that's pretty much how it was in Pakistan as well, where we thought tech was going to be the catalyst for the microfinance sector. But what happened was at the time, the microfinance institutions were not regulated in Pakistan. They were operating under the trust structure. Well, around about that year, the SCCP here, they introduced new regulations whereby they were required to become regulated. So, I think for them, the focus was number one on the transformation. The digital focus was still, it was still very early, I think we were a little ahead of our times in terms of when we started that first startup. This is back in 2014-15. That's when we actually got in touch with our third co-founder. The name was Sen, who happened to be the founders of the largest microfinance bank in Pakistan at the time. And also, the leading branches banking provider. So Tamir Bank and Easy Vesa. So that's when, we decided to join hands, and with the model of check-in pivoted to a direct-to-consumer model, where we then got our own license to lend. So Pays became the first fintech in Pakistan to get a digital lending license. And we started off with nano loans. These were under $20 loans given out for anywhere between 30 to 60 days. And we actually gave out these loans under 10 minutes for new users, under 2 minutes for repeat users, using, their smartphone data and doing credit scoring on that. So that's how, they started. Well, the vision was always to be a full stack digital bank, but with time, Forte developed into the nano credit consumer lending space.
You talked about measuring the credit risks as well as automating the process. What sort of data were you using? How were you building your models to be comfortable in the decision you were making, but still to be doing it so quickly?
Well, in Pakistan, then and even now, one of the biggest challenges that digital lenders have is that there's very fragmented as well as scarce data or access to data. The holders of the data are either the banks or the telcos. And none of them are willing to really share this data because they believe that more than being just a custodian, they're the ones who are supposed to just sit on the data, which is something that I think now that understanding is being developed. But, data for the longest time has been quite a challenge. Now, when we started lending with this, it was quite an interesting journey because Pakistan, while, the financial inclusion numbers were very bleak. If I talk about when we started, there were about 60 million mobile subscribers. Now there are over 100 million. So, it actually has been growing very fast. Every second person in Pakistan has a smartphone. It's a smartphone. It's actually literally like a digital footprint. It's like a biometric of your life, actually. It tells you everything about you. It has proxies on your financial data, your behavioral data, your social demographic data, your geographic data. So we actually started developing algorithms, studying this data. And on the basis of that, we started lending. From the SMSs, for example, we could find out any financial transaction that happened, that the SMS is actually, they give you that information. So we could have developed cash flow statements from the SMSs that the customers received. Anything from, incoming, outgoing calls, what kind of phone someone owns, what are the contact affinities. So there's so much that we actually got from the smartphone on the basis of which we developed algorithms. Before we started developing our algorithms, we actually had to go into the market and understand how the consumers were lending. Interestingly, when we started lending, over 70% of the people who came to us in our first cohort They did not even have a bank account. So we literally helped these people create bank accounts, like mobile wallets. And our first cohort was probably the best part of the learning journey for us, because we actually got over 50% defaults on that first cohort. And this is when we went without any credit scoring, without even any business rules. We were like, we should actually shut down this business because this seems to be flunking very badly. And then we had this conversation with some experts. We, tried to understand what was going on. And in retrospect, it was actually good for us, because that's when we learned about managing fraud the most. We had, a couple of borrowers at the time who were literally defrauding the system so well that we actually thought of hiring them at one stage, So it was actually quite a journey. And that's when we started strengthening the business engine.
Yeah.
Business rules were developed. And then, the credit scoring engine started taking shape. And over, cohort after cohort, we started bringing defaults down from 50 to 40, 40 to 30, 30 to 20, 20 to 15. And then, the tougher bit came, because it was not only about the credit scoring. It had to be a lot of engineering then. It's about the experience of the consumer. How is the product structured? The first interaction of the consumer with the company till after he or she has repaid, everything matters. How the lead generation happens. How is the customer support interacting with the customer? What has been the experience in-app? What is the experience at the point of repayment? If we've seen actually many times if the customer faces challenges in repaying, whether or not it was our issue or an issue at the wallet side, the customers could turn rogue. So there was so much to it that we learned over time. And, when we actually closed our lending book pre-acquisition, the latest cohort actually closed at under 3% default. So this was uncollateralized cash lending to the masses. So yeah, it was quite an interesting experience and a lot that we learned from it.
And I wonder if your background maybe primed you a little bit better to understand that this is not the traditional banking model, but an e-commerce type of product approach.
Yeah, I think, Brendan, what also has changed over, the last 20 years is that now consumers have many more choices, and they've become a little more aware of their rights as well. Where once upon a time, microfinance lenders could have gotten away with stringent recovery practices. Today, they can't even think of, because there are regulatory repercussions in them. But also, on the digital side now, with borders becoming more and more wiped off, it's interesting how digital is playing a role in the understanding that consumers have. They become much more savvy. Consumers are very, very sharp in terms of managing digital fraud. While it's not a great thing to be known for, it's still smart. That's become a challenge as well. While we're serving the masses and trying to support the wider good, there are elements within the ecosystem where those challenges come from, and that can actually, amplify the risk of loss.
You were the first in the market, but have you seen the market start to follow you? And is there a general modernizing in, I guess, credit, but more broadly in terms of things like access to bank accounts for consumers in Pakistan?
So yeah, it's actually very refreshing to see. So see, in financial services, there are different types of services that you're aware. There's payments, there's savings, there's insurance, and of course there's credit. Now, in terms of payments, it's a difficult business to grab because the margins are very low in payments. And the cost of infrastructure is usually very high unless, there's already some railroad that's been set. It has to be a high volume business to start making sense. Now, credit, on the other hand, is a high margin business, if it works, if the model works. So I think a lot of players have now started to understand that. But understanding how to manage default is still an art and a science. While, you have every other player is becoming a fintech, and that to a lending fintech now, because they see the opportunity, they clearly see the opportunity. In Pakistan, you have a 230 million population, over half of which does not have access to financial services. In terms of credit, even worse, That opportunity, a lot of people are following, not only local, but also international players are now coming into the market. And you see players entering both the consumer lending and the SME lending space. That's very heartening to see. Nonetheless, I believe that the ecosystem is still not completely ready to be conducive to digital lending at scale. And there are various reasons for this. Number one, of course, the kind of funding that you need to scale it. You can't keep on funding the lending business from equity. There have to be sources coming in from debt, for example. In case of banks, deposits, they resolve for that purpose. But debt, on the other hand, is still very difficult, particularly local currency debt. So that's one challenge. Secondly, the challenge of data still persists. The State Bank, Central Bank of Pakistan, is developing a framework for open banking. But, that too probably will take a year for things to actually fall into place till players can actually start using that data, because someone will have to actually report to that bureau before you actually can access that data, right? So it's going to be a trial and error. And third, I think players themselves, I think everyone is going to go through their own journeys to learn, how it is going to be for them. I think even for us, there's an entrepreneur ego where you actually have to go through that journey yourself to know, okay, this is how it works, and, experience it for yourself. The market is huge. The need is huge. And there's no really one single player that has been able to crack the nut or even can, because the need is so huge that you need multiple players to be in this industry.
Yeah, well, let's pick up on that entrepreneur side. We talked a bit about the learnings in terms of credit and your risk modeling at Taze, but what's the business story been like? 6 years ago that you founded the business in a market that obviously has historically had a lot of gaps in there. So a difficult start, then just as I guess you're finding your feet, you've got COVID coming through. So it must have been quite an adventure, but you've done really well in growing the business. So what has that experience been like?
That's a tough one, actually. Last 6-7 years, we've literally been eating, breathing, sleeping days. And yeah, it was actually a roller coaster, because we've experienced some great times and then some very tough times. I'd say this often, when COVID struck, our investors, they were like, it's a very uncertain market. I was like, when was it certain for entrepreneurs? We enter into it knowing it's going to be uncertain. You never know if succeed in the next years. It was actually the purpose. That was larger than everything, It was larger than the company, larger than the investors, larger than the team. That's what kept us driven, And I think, to be very honest, things were not easy when COVID struck. And fundraising itself had become tougher. I think it was easier for newer companies that came into the space. For companies that had already some traction, for them it was definitely tougher to raise funding, and that too on the lending side, because it was a risky avenue. But I think we were very fortunate how it panned out with Zood coming in. And I think it seemed very serendipitous about how ultimately transitioned into Zood. And I think it was quite a great learning experience for us. We're still learning it.
You're part of the ZoodPay family now. What does that bring both, I guess, to the business Taze there, but also maybe your ambitions in terms of regional expansion more generally?
So Zood's initial vision was actually, they started off as an e-commerce player, and then they won into a BNPL player. It wasn't until the Taze deal happened that, we actually learned of their overall vision, where they're transitioning more from an e-commerce player to a lending player. So they're now, a digital lending platform for e-commerce versus an e-commerce company doing BNPL, right? So when the deal was happening, both for Hamza and myself, I think one thing that we were very certain of was that we want, whatever we were going to set our hands on, it had to have a purpose. And to be very honest, BNPL did not resonate with us a lot because of whatever was happening in the market. So that was something that, we were struggling to embrace. But then I remember Michael, who's the CEO and the founder of Zood, he flew to Pakistan and we had a few conversations with him. And he shared his vision of how, the story was actually to bring impact on a wider level, which wasn't only the consumer lending space, but also the SME lending space, and to develop the overall ecosystem. So I think that's when it started making sense to us. One thing that we very strongly believed in is whatever, we want to do, it has to have a longer term, sustainable impact. Unfortunately, for most companies started, usually the view is very myopic. It's short term, quick returns, and that's it. For us, the impact for Pakistan, that's what we always wanted. Have players that can actually build an ecosystem, because that's the only way you can sustain and grow, in a market like ours. So I think Zood brought that. The alignment and the visions that mattered. The impact story mattered. And then most importantly for us in terms of the deal, what mattered was how the team was going to get absorbed into the overall global team. That actually brought us a lot of comfort. We actually literally hit the ground running, because now the focus is the enablement of the SME to bring, the SME online for e-commerce, and then propel SME lending, and then traction for the SME via BNPL on our own marketplaces. That ecosystem in Pakistan, now in Pakistan, it's something that we did not have at the time at Taze. And we understand the strength of that ecosystem, because it helps you not only manage a consumer journey, but also the defaults. So that's, something that we're really excited about. And Zood right now is in 6 countries. Uzbekistan is where they started from. So Uzbekistan, Jordan, Lebanon, Kazakhstan, Iraq, Pakistan. These countries themselves have huge potential. We right now have 10 million users globally. And so we're concentrating on what we have right now. This time right now, well, it's not the easiest of phases to be in for any company. So the focus is to remain relevant and to remain alive. And of course, grow in a very smart and sustainable manner so that, we can then build a foundation where we can then grow on in the later years.
I don't know Pakistan as a market very well, but I'm from South Africa and talking to a lot of the lenders there. During COVID, there was a huge push towards e-commerce. And we saw that in the UK as well, but it wasn't in terms of the kind of mindset that big a change. It was just more people did their groceries online and things, but they were already familiar with their Amazons and things. Whereas South Africa, we saw a lot of new people going on to e-commerce and this big boost to lenders who could understand that. And I imagine Pakistan's in a similar position where to be able to allow both of those really important industries to grow simultaneously and together, I think is a big win. Naureen, if we talk about, as you said, you've got a lot on your plate at the moment, a lot of focusing on getting that settled, and this market in Pakistan, which has so much potential. India gets a lot of the headlines, but obviously Pakistan also a huge market, and as you said, very untapped. So if people are listening and they want to learn a bit more, they want to do some more research into the Tay story or follow you as ZoodPay now, where are the places they can go to connect with you or to see what's happening in that space and keep a track of that story?
We have a website. Now it is rebranded as Zood. You can contact us through our website. We also have our emails where you can contact us. Personally, you can approach me on LinkedIn, Naureen Hyat. You can see my spelling. So you can reach me out and I'd be happy to share whatever you'd like to know more on the story.
Great, thanks. Yeah, I'll add those in the show notes as well. But I guess the Hyatt hotel brand probably confuses people. So yours is with the 1T. But thank you very much. As I said, it's not a market I knew well, but one that as soon as I started looking at just seems ripe for disruption. You see, even if you look to the neighbors, to Bangladesh, to India, the gap in terms of access to banking is significant. And 10 years ago, that would have been insurmountable in terms of logistics, whereas now with smartphones, it's not. So I think there's a lot more to happen in that space, and just overall a great story in terms of understanding the value of automation, of digitizing, the understanding or very quickly learning how to make full use of alternative data and understanding that customer life cycle. I think it's 20, 30 years worth of innovation that's happened in other markets happening just in a couple of years.
Thank you so much, Ben. Thoroughly enjoyed our conversation. And, it's great to know you know so much about the field itself. So a lot to learn from yourself as well.
It's a pleasure. Thank you. And thank you all for listening. Please do look for and follow the show on your favorite podcast platform and share the updates widely on LinkedIn, where lending nerds are found in our largest concentration. Plus, send me a connection request while you're there. This show is written and recorded by myself, Brendan LaGrange, in Brighton, England, and edited by Fina Charlson of FC Productions. Show music is by I Am Wake, and you can find show notes and written transcripts at www.howtolendmoneytostrangers.show or just www.htlmts.show, and I'll see you again next Thursday.